Welcome back to the Deep Dive. Today we're looking at a set of documents you sent over about what seems like a pretty major regulatory shift in the Indian investment world.
It really is. We're talking about something that's trying to fix a structural gap that's been there for years.
A structural gap, I like that. It sounds like an opportunity.
It is, depending on how you look at it. It's that space between, really sophisticated investment strategies and the kind of accessible, regulated products most people can get into.
And that brings us to our focus today. These new Specialized Investment Funds, or SIFs, that SEBI has introduced. We're going to use one particular fund as our case study to really get under the hood.
Yeah, the ICICI Equity X Top 100 Long-Short Fund.
That's the one.
It's a great example because its new fund offer, the NFO, is timely. It opens January 16th and closes on the 30th, 2026.
So our mission is pretty clear. Figure out what these SIFs are and how this fund plans to use these new rules to tackle, well, one of the trickiest parts of the market, the small and mid-cap stocks.
Really volatile stuff.
Exactly. So let's start with that regulatory bridge. Where do SIFs actually fit into the picture?
Well, you have to understand why they were created. It was almost out of necessity. You have two completely different worlds. On one side, you've got your standard mutual funds, MFs.
Okay, the ones that everyone knows.
Right. Highly regulated, super accessible. You can start with a tiny amount of money. But, and this is the key, they're very, very restricted in what they can do.
When you say restricted, you mean with complex tools?
I mean, with derivatives. They can basically only use them for hedging.
So just for protection, it's like buying insurance.
That's a perfect analogy. It's purely defensive. Now, on the complete other end of the spectrum, you have things like portfolio management services, PMS, and alternative investment funds, or AIFs.
And these are the big leagues.
Totally. They have almost total flexibility. They can go long, they can go short, they can use derivatives aggressively to generate returns, but the price of admission is steep.
We're talking huge minimum investments, right?
Yeah.
Huge. Minimums of 50 lakh rupees, often more, like a crore. It's really for the ultra-high net worth crowd.
So if I were, say, a high net worth individual with maybe 20 or 30 lakh to invest, and I wanted that kind of flexibility, I was just stuck in the middle.
You were completely out of luck. There was no product for you. And that is the exact gap the SIF is designed to fill.
Okay, so how does it do it?
It operates under a specific part of the SEBI mutual fund regulations, so it keeps all that strong oversight. And, importantly, the low expense caps of a mutual fund. We're talking a max of 2.25%.
But the big headline here, the thing that really changes the game, is the minimum investment.
That's the ticket. It drops all the way down to just 10 lakh rupees.
Wow.
So you're getting access to what is basically an institutional level strategy for a fraction of what it used to cost.
And you get those power tools you mentioned?
Yeah.
We have to talk about unhedged derivatives because that seems to be the engine for this whole thing.
It is. So if a regular mutual fund using derivatives is just hedging insuring the house, like you said,
Right.
an SI is allowed to use unhedged derivatives. That means they're not just protecting against risk. They can actually use the derivative to make a directional bet, to actively try and make a profit.
So the derivative itself becomes a tool for making money, not just saving it.
Precisely. And that unlocks strategies like long-short investing, which is what this fund does. It's all within that regulated, lower-cost mutual fund structure. It's a whole new world of flexibility.
Okay, so the manager has these powerful new tools. But who are they aiming them at? What is this X Top 100 stock universe?
It's a simple definition, really. It's just everything outside of the large caps. So your mid-cap and small-cap stocks, the industry calls them SMEs.
And this is a big playground. The source materials say the research covers something like 550 companies.
It's huge. But it comes with one massive flashing warning sign.
Volatility.
Volatility. These stocks are just way more reactive than large caps. History shows us they can have these incredible runs in a bull market, just spectacular performance.
But they give it all back, and then some, when the market turns.
Exactly. I mean, you look at the charts for FY 2020, you see some of these mid-cap indices down 35%. It's brutal.
And that's driven by real factors, right?
Yeah.
Less analyst coverage, thinner trading volumes.
Yeah, and a bigger reliance on retail investors who, can panic more easily. When fear hits, SMIDs get hit the hardest.
Which is funny because the underlying trend is actually positive. The documents show the SMI share of the total market cap has been climbing steadily.
It has. It's gone from about 36% in 2017 to 39% in 2025. The growth is there. You want to capture that, but you desperately need a shield for the downturns.
And that's where psychology comes in, that greed and fear cycle. You see your stocks flying, you feel euphoria, you buy more, and then you panic sell at the bottom.
We've all been there. It's an emotional roller coaster, especially in this part of the market. And that's why the long-short strategy is presented as the solution here. The whole point is to make money when the market is going up and when it's going down.
Lower volatility, better risk-adjusted returns. That's the pitch.
That's the whole pitch.
So let's get into the mechanics. How does this fund actually plan to do that? The dynamic allocation part seems really crucial.
It is. So at its core, it's an open-ended fund focused on that SMID space. The rules say 65 to 100% of its assets have to be in those X-top 100 stocks.
So the growth engine, the long positions are always on.
Always. But here's the safety valve. Thanks to the SEF rules, they can have up to 25% unhedged short exposure using derivatives.
Which means they are actively betting that certain stocks will go down.
Correct. They can short the stocks they think are the weakest or most overvalued in that universe.
So just to be clear for everyone listening, if the whole market drops 10%, their long positions take a hit. But if their short positions make money from that drop, it cushions the blow.
It dampens the overall fall. You're using the weakest companies to protect your conviction in the strongest ones. It's a classic long-short mechanic.
Now, let's look at how they shift this based on their market view. They have these two scenarios, positive and negative.
Yes, and the playbook is very different for each. In a positive market scenario, they go all in. SMID allocation goes right up to the 100% limit.
And what about large caps?
Low to nil. They don't want the defensive assets. They want maximum growth exposure. They also keep things like call option writing low because they want all the upside they can get.
So it basically runs like a very aggressive, pure SMI fund.
That's the idea. But when they see a negative market scenario on the horizon, the whole posture changes.
They pivot.
They pivot hard. The SMID allocation has to stay at least 65%. That's the mandate. But the defensive layers kick in.
And what are those layers?
First, they start buying the big guys. They can allocate up to 35% to top 100 large cap stocks. That's a flight to safety and liquidity right there.
Okay, that makes sense. What's the second defense?
This is key. The allocation to call option writing goes from low to high.
Okay, explain that. What are they actually doing when they write a call option?
In simple terms, they're selling volatility. When the market is fearful and negative, volatility is high, and the price of options, the premium goes up.
So they sell these expensive options.
They sell call options on the stocks they already own. They get paid that premium up front immediately. It's instant income that acts as a cushion against the losses they expect on their long positions.
So they give up some of the potential for a huge rebound in exchange for guaranteed cash right now.
That's the trade-off. In a bad market, they're moving into large caps, they're shorting weak stocks, and they're actively generating income by selling that fear premium. It's a three-pronged defense.
It sounds incredibly active, a lot of moving parts.
It is, and that's before you even get to the other ways they generate alpha, stock selection, debt securities, investing in IPOs. It's a very complex machine.
Which means their stock selection has to be rock solid. What are they looking for in these SMID
We
companies?
have a 5-point checklist. It's all about finding stability in a chaotic space.
So what's on the list?
First, is it a potential market leader? Does it have scale, a strong network? Second, a strengthening balance sheet. They want low debt and lots of cash. A small recession shouldn't be an existential threat.
That feels like table stakes for this kind of market.
It has to be. Third, is it a low-cost producer? Does it have some kind of competitive moat? Fourth is earnings potential. They need to see that profits will be there through the cycle. And finally, valuation comfort. It can't be priced for perfection.
So even a super exciting, high-growth company might get cut if its balance sheet is weak or it's too expensive.
That's the discipline they're aiming for. It's a very bottom-up, fundamental approach.
Okay, let's get to the report card. The back-tested performance, the numbers here are pretty wild.
They are. The model beat the Nifty 500 benchmark in 9 out of 13 years. That's a good hit rate.
Right.
But you have to look at the magnitude of the wins and losses.
Right. In FY21, a huge bull run, the model did 109%. The index did 77. Massive outperformance.
Absolutely massive. But then you look at a more recent period, FY24. The model returned about 26%, while the index did over 40.
So it underperformed significantly.
And that's the reality check. This strategy is not the index. Its success depends entirely on the manager making the right calls at the right time. That's why the fund has a risk level 5 higher risk designation.
It's a reminder that with high potential returns comes, well, high risk.
Of course, you are betting on the active manager's skill, pure and simple.
So let's tie this all together. If we're synthesizing this for you, the listener, what's the big takeaway here?
I think it's that the SUF structure is a genuine innovation. It's taken the high regulatory standards and lower costs of a mutual fund and merged them with a kind of flexible, powerful toolkit that used to be only for the super wealthy.
It creates a new middle ground. It gives investors with a more manageable entry point, a way to access a volatility-focused strategy in one of the highest growth but also highest risk parts of the market.
Exactly. But it also leaves us with a pretty important question to think about.
Yes.
We saw the back-tested data. We saw the huge swings in performance, both positive and negative. The success of this whole thing hinges on the management team's ability to execute these really dramatic pivots, right? To go from all-out attack to full defense almost overnight.
That timing have to be perfect.
It has to be perfect.
Yeah.
So the question for you to consider is, how effectively can even the most sophisticated derivative strategies really tame the raw, inherent volatility of small and mid-cap stocks? And what level of faith do you need to have in that active manager to believe they can consistently time those crucial shifts year after year? That's the real question that will determine if this works long after the NFO has closed.